There is a saying among technicians that volume goes with the trend. Basically, during a true bull market, trading activity will expand during market advances and contract during periods of falling prices. If a sharp drop in the Dow Jones Industrial Average is accompanied by light volume, analysts consider that to be a favorable sign. If, on the other hand, volume expands during a market sell-off, it is interpreted as a negative or bearish sign for the overall market. The financial press reports volume daily. When discussing the performance of the Dow, the volume represents the day's volume on the New York Stock Exchange, which is not necessarily correct because the Dow currently includes 2 Nasdaq stocks. Nevertheless, a reporter might say something like, the Dow fell 50 points on Tuesday, on volume of 1.9 billion shares. When discussing the performance of the Nasdaq, investors look at the total volume on the Nasdaq stock market. Investors can also track the trading volume of individual exchange-traded funds to determine whether there is more buying or selling pressure. For example, if the volume of the Qs is increasing while its price moves higher, it is a sign that the trend is healthy and on solid footing. However, if volume rises during the declines, a move to the downside is gathering momentum. Most charting software allows traders to place volume bar charts below the price data, like the chart shown in Figure 3.11. In this example, notice how volume is rising during the up days. The arrows point to examples of up days on high volume. This is a bullish sign. This is considered a positive indication that the trend has staying power. During a market advance, the strategist wants to see increasing volume on the up days and trading the market 45 linearly weighted moving average, a type of moving average that gives greater weight to the latest data. For example, to compute the 10-day linearly weighted moving average, the analyst might take the closing price of the 10th day and multiply this number by 10, the 9th day by 9, the 8th day by 8, and so on, as with the exponential moving average. Then the products are divided by the total number of multipliers. In this example, the total number of multipliers is 55, 10 plus 9 plus 8 plus 1. The linearly weighted and exponential moving averages are considered superior to simple moving averages because they assign more importance to new, rather than old data. 46. The Index Trading Course. Figure 3.11 ETF with volume chart. Source: www.profitsource.com. Declining volume on down days. During a bearish trend, volume tends to increase on the down days. Conclusion: financial markets move in trends. Some trends are short and last only a few days, but others unfold over several years or even decades. The longer the trend, the more powerful the price moves and the greater potential for profits. Indexes, along with the other tools presented in this chapter, can help traders identify and move with the trends. Importantly, all trends eventually reach an end. When it happens, much of the investment community is caught by surprise because reversals often occur when the majority least expects it. So, while trends are important, identifying turning points is also important. Indeed, trends and reversals are extremely important to trading not just indexes, but any markets. This chapter focuses on trends. Later chapters help identify reversals. Up next, however, is our first discussion of options and the basics of trading puts and calls in the index market. 47 Chapter 4 Understanding Options. Indexes serve two purposes. First, an index can provide a tool for gauging the price changes in a group or basket of stocks. The Dow Jones Industrial Average (INDU) and the Nasdaq Composite Index (COMPQ) are mentioned frequently in the business news. These two barometers for the performance of the U.S. stock market are examples of market indexes. Meanwhile, as we saw in Chapter 3, sector indexes are used to gauge the performance of specific industry groups, such as biotechnology, semiconductor, or energy stocks. Indexes can also be used as trading vehicles. For example, options and futures on the S&P 500 index are among the most actively traded financial derivatives today. In addition, many sector indexes and exchange-traded funds have options linked to their performance. However, before implementing strategies using options based on indexes or ETFs, traders need to develop a solid understanding of option contract basics. History of options. The history of organized options trading in the United States dates back roughly 30 years. Its roots can be traced to the founding of the Chicago Board Options Exchange in 1973. By the end of that year, options had traded on a total of 32 different issues and a little more than 1 million contracts had traded hands. 48. The Index Trading Course. In 1975, roughly 2 years after the founding of the first U.S.-based options exchange, the Securities and Exchange Commission (SEC) approved the Options Clearing Corporation (OCC). The OCC was created as the clearing agent for all U.S.-based options exchanges and still performs that role today. As clearing agent, the OCC facilitates execution of options trades by transferring funds, assigning deliveries of derivatives contracts and guaranteeing the performance of obligations. The early 1970s also witnessed other important events related to options trading. In 1973, Fisher Black and Myron Scholes wrote a research paper outlining an analytic model that could determine the fair market value of call options. The findings were published in the Journal of Political Economy and the model became known as the Black-Scholes options pricing model. It is still the options pricing model used most widely by traders today. As options trading grew in popularity, other exchanges started trading these investment vehicles. In 1975, both the Philadelphia Stock Exchange (PHLX) and the American Stock Exchange (AMEX) began trading stock options. In 1976, the Pacific Stock Exchange (PCX) entered the options trading scene. All three became members of the OCC, and all three still trade options today. In addition, in 1977, the SEC permitted the trading of put options for the first time. In 1975, 18 million option contracts were traded. By 1978, the number had soared to nearly 60 million. The 1980s also saw an explosion in the use of options, which eventually peaked with the stock market crash of 1987. The CBOE launched the first index options in the early 1980s. In 1983, the exchange began trading options on the S&P 100 index, $OEX. This was the first index to have listed options. In 1993, the CBOE Volatility Index, $VIX, was derived from OEX option prices. The VIX became the market's first real-time volatility index. Today, the CBOE Volatility Index measures the implied volatility of S&P 500 index options. When it rises, traders are becoming more bearish and are worried about future market volatility. For that reason, VIX is sometimes called the fear gauge. Low VIX readings are a sign of bullishness or complacency among traders. The early 1980s saw a growing interest in both stock and index options. From 1980 until 1987, annual options volume rose from just under 100 million contracts to just over 300 million. After the market crash in October 1987, however, investor enthusiasm for options trading waned and less than 200 million contracts traded in the year 1991, or roughly two-thirds of the peak levels witnessed in 1987. Throughout most of the 1990s, trading activity in the options market improved. In 1990, long-term equity anticipation securities (LEAPs) were introduced. These are option contracts that expire in years instead of months. The OCC and the options exchanges created the Options Industry Council (OIC) in 1992. The OIC is a nonprofit association created to 49. Understanding options. Educate the investing public and brokers about the benefits and risks of exchange-traded options. LEAPs. Long-term equity anticipation securities, or LEAPs, are long-term options contracts, either puts or calls, with expirations up to 3 years in the future. LEAPs are available on the more actively traded stocks, ETFs, and indexes. Note, the minimum amount of time for a LEAP option is 9 months. In 1998, the options industry celebrated its 25th anniversary. In 1999, the AMEX began trading options on the Nasdaq 100 Index Trust QQQQ, an exchange-traded fund that is among the most actively traded in the marketplace today. That same year, total options volume surpassed 500 million contracts for the first time ever. In the year 2000, a new options exchange arrived on the scene. On May 26, 2000, the International Securities Exchange (ICE) opened for business. It was the first new U.S. exchange in 27 years. In addition, the ICE became the first all-electronic U.S. options exchange. In 2001, the options exchanges followed suit with equities trading and converted prices from fractions to decimals. Another player entered into the options trading foray in February 2004. The Boston Options Exchange, the BOX, received regulatory approval and started trading puts and calls. The entity was formed by a joint venture among the Boston Stock Exchange, the Montreal Exchange, and Interactive Brokers. The BOX became the 6th U.S. options exchange. A great deal has changed in the options market during the past few decades. Not only are there 6 U.S. exchanges today versus only one 30 years ago, but a variety of different products including options on indexes and exchange-traded funds have also become available. Although the first index option began trading in 1983, it was not until 1999 that options began trading on exchange-traded funds. Today, index and exchange-traded funds represent a sizable portion of the total options market. Stocks versus exchange-traded funds. Stock represents ownership of shares in a corporation. When companies are publicly traded, shares of stock are listed on one of the exchanges such as the New York Stock Exchange or the Nasdaq stock market. Prices are quoted throughout the day, and investors buy and sell shares on an ongoing basis. An investor who buys shares is taking an equity position in the company and becomes one of its owners. If the company performs. Continued. What is an option? Since the 4 books that preceded the index trading course covered options extensively, we don't want to spend a lot of time rehashing the basics of options contracts. Readers needing an in-depth discussion of options are encouraged to pick up a copy of any of our previous books, the Options Course, the Stock Market Course, Trade Options Online, or the Volatility Course, or visit us online at optionetics.com. Nevertheless, in order to understand the trading techniques discussed later in this text, a basic understanding of options is in order and the next few pages serve this purpose. Options come in 2 flavors, puts and calls. Both types of option can be purchased or sold. If an investor buys a call, she has entered into a contract that gives him/her a right to buy a stock futures contract, ETF, etc., at a predetermined price known as the strike price. The contract is valid for a specific period of time, until the expiration date. After the time has lapsed, the option expires. So if you buy a June 50 call option on Microsoft, it gives you the right to buy or call the stock 100 shares for every call contract, at a specific price $50 a share for a specific period of time until June expiration. An investor who sells an option must honor the terms of the contract. Hence, a call seller, or writer, has the obligation, if the option is assigned, to deliver the underlying security at a specific price until the option's expiration. The seller has no choice. So if you sell a June 50 call on Microsoft, you are agreeing to deliver the stock to the assigned option buyer at $50 a share, regardless of Microsoft's current market price, if the option is assigned. Assignment occurs when an option buyer exercises his/her option by delivering a notice to the option seller, requesting the option seller to fulfill the terms of the options contract. This includes delivering the underlying security for a call writer or accepting delivery of the underlying asset for the put seller. A put option can also be bought or sold. A put buyer enters into an 50-THE index trading course. Stocks versus exchange-traded funds. Continued. Well, the stock price can go up and yield profits to the stockholder. Indexes track the prices of a group of stocks. Exchange-traded funds are pools of money that hold baskets of stocks and issue shares to the public. Therefore, shares of ETFs also trade on the exchanges like stock. Options trade on stocks, exchange-traded funds, and equity indexes, and are called stock options and index options. Agreement that gives him/her the right to sell the underlying asset at a specific price for a predetermined period of time. If I buy a Microsoft June 50 put option, I have the right to sell shares of Microsoft 100 shares per each contract for $50 per share from now until the option expires in June, regardless of the current price for Microsoft. A put seller, on the other hand, takes on the obligation to buy the underlying asset at a specific price, known as the strike price, for a predetermined period of time. A trader who writes a Microsoft 50 put has entered a contract that obligates him/her to buy the stock at $50 per share, again, regardless of the current price of Microsoft. Option mechanics. Each options contract can be described using the following 4 factors. 1. The name of the underlying security. 2. The type put or call. 3. The strike price. 4. The expiration date. When discussing options, the 4 variables provided are used to identify the specific contract. For example, the $SPX June 1500 call describes a call option on the S&P 500 index, a cash index, that expires in June and has a strike price of 1,500. The QQQQ October 30 put is a put option contract on QQQQ, an ETF, that expires in October and has a strike price of 30. The price of an option is quoted in dollars and cents like the price of a stock. For example, a QQQQ October 30 call might trade for $3, with a bid price of $2.90 and an ask price of $3. Therefore, it costs $3 to buy that contract and it can be sold for $2.90. The difference between the bid and the ask offer is known as the spread. It's important to note that the cash required to buy one QQQQ October 30th call in this example would be understanding options 51 put option, an option contract that gives the owner the right, but not the obligation, to sell, or put, the underlying asset at a specific price, called the strike price, for a specific period of time, known as the expiration date. Call option, an option contract that gives the owner the right, but not the obligation, to buy, or call, the underlying asset at a specific price, called the strike price, for a specific period of time, known as the expiration date. $300 because each options contract contains 100 shares. Therefore, in order to determine the cost of an options contract, one must take the value of the option in the market and multiply it by 100. The cost of an options contract is also known as the premium. Key determinants of option prices. Options are often called wasting assets because their values decline as time passes. This phenomenon is known as time decay. All else being equal, an option that is valid for the next 6 months is worth more than an identical option that has only 1 month left until expiration. You have the right to exercise the former option for 5 months longer. However, while time is a key element in determining the value of an options contract, it is not the most important factor. The price of the underlying security is the most important factor in determining the value of an option. Most of us learn this early on in our trading careers. For example, we buy calls on XYZ stock because we expect XYZ to move higher. The call option gives us leverage. It will increase in value as XYZ moves northward, but the small cost translates into a large percentage return. In order to really understand how option prices work, however, it is important to understand that the value of an option is determined largely by the relationship between its strike price and the price of the underlying asset. In fact, the difference between the strike price and the price of the underlying asset plays the most important role in determining the value of the contract. The relationship between the price of the underlying asset and the strike price of the option is known as moneyness. The terms in the money ITM, at the money ATM, and out of the money OTM are used in this context. For example, a call option is in the money if the strike price of the option is below the price of the underlying asset, and out of the money if the strike price is above the price of the underlying security. So a call can move from OTM to ITM as the stock price moves higher. On the other hand, a put option is in the money if the strike price is greater than the price of the underlying security, and out of the money if the strike price is below the price of underlying security. So a put can move from OTM to ITM as the price of the underlying security moves lower. See Table 4.1. A call or put option is at or near the money if the strike price is the same as, or close to, the price of the underlying security. 52. The Index Trading Course. 53. Understanding Options. Table 4.1. Option moneyness. Price of XYZ equals $100. Strike price. Call option. Put option. 120. OTM. ITM. 110. OTM. ITM. 100. ATM. ATM. 90. ITM. OTM. 80. ITM. OTM. Table 4.1 summarizes moneyness with a hypothetical example. If the current price of XYZ is $100, both the 100 put and the 100 call are at the money. However, the 120 put is in the money and the 120 call is out of the money. The higher the asset price relative to the call option's strike price, the more the call option is in the money. The difference between the strike price and the underlying asset's price is known as intrinsic value. When call options have a large amount of intrinsic value, or the asset price is considerably above the strike price, it is said to be deep in the money. The opposite holds true for put options, that is, when the price of the underlying asset is below the strike price the put option has intrinsic value, it is in the money. If the price of the underlying is much lower than the strike price, the put option is deep in the money. An out-of-the-money call option will have a strike price above the underlying stock's price and an out-of-the-money put will have a strike price below the stock price. Out-of-the-money options have zero intrinsic value. When the strike price of a call option is considerably above the stock price, it is considered deep out of the money. Similarly, when the strike price on a put option is considerably below the underlying asset's price, the option is considered deep out of the money. Knowing whether an option is in the money, at the money, or out of the money will help you determine whether the option is likely to be exercised. Exercise occurs when the call option owner decides to buy the stock in accordance with the rights under the call option contract, or when the put owner sells the stock in accordance with the rights under the put option contract. Near expiration, an option that is in the money will have a greater chance of being exercised. For instance, suppose a strategist buys shares of XYZ stock for $50 a share and sells the December 50 calls, a strategy known as a covered call. If at expiration the Saturday following the 3rd. 54. The index trading course. Friday in December, the stock climbed to $55 a share, the call would have an intrinsic value of $5. It is likely to be exercised and the stock will be called away from the option writer for $50. Exercise is all but assured when an option is in the money at expiration. In fact, the OCC automatically exercises any option that has intrinsic value of 0.25 or more at expiration, whether the option holder requests it or not. What happens to in-the-money options before expiration? When there is a considerable amount of time left before the option expires, chances are less that an in-the-money option will be exercised. The reason that an option with intrinsic value will probably not be exercised ahead of expiration is due to the fact that the option also has a different type of value, i.e., time value. The time value of an in-the-money call is computed as follows. Call time value equals call option price plus strike price, stop price equals call option price, intrinsic value. Time. Time is the second most important factor in determining an option's value. The greater the amount of time value in the option's premium, the less likely the option will be exercised. But time value decreases as time passes. Importantly, time value decreases at an accelerating rate. As a result, an option with only 1 month of life remaining will see time value erode faster than an options contract with 6 months remaining until it expires. At expiration, time value will equal 0. At that time, if there is no intrinsic value, i.e., the option is not in the money, it becomes worthless and will not be exercised. Therefore, the odds of exercise increase as 1. The option becomes in the money, and 2. The time value of the option diminishes. As noted earlier, the amount of time left until an option expires has an important influence on the option's value. Specifically, all else being equal, the more time left until an option expires, the greater the value of the option's contract. As time passes, the value of an option will decline. It is important to understand the impact of time decay on a position. Dividends. The dividend is another determinant of a stock option's price. A dividend is a payment from a corporation to a shareholder. Dividends are often paid quarterly and represent a distribution of profits to stockholders. These payments will lower the value of the stock price after the dividend is paid. Hence, dividends also affect the prices of stock options. 55. Understanding options. Obviously, if the stock pays no dividend or if we are dealing with a futures contract or index, the dividend makes no difference. However, a dividend will lower the value of a call option and increase the value of the put option. In addition, the larger the dividend, the larger an impact it has on the price of the corresponding call option. Therefore, stocks with high dividends will have low call option premiums and higher put premiums. Interest rates. Changes in interest rates can also have an impact on option prices throughout the entire market. Higher interest rates lead to somewhat higher option prices, and lower interest rates result in lower option premiums. The extent of the impact of interest rates on the value of an option is subject to debate, but it is considered one of the determinants throughout most of the options trading community. Volatility. Volatility is an extremely important factor in determining the value of an options contract, so important that we have written an entire book on the subject. The volatility course outlines and defines various measures of volatility and also how to trade volatility using options contracts. Why is volatility so important? All else being equal, the greater an underlying asset's volatility, the higher the option premium. To understand why, consider buying a call option on XYZ with a strike price of 50 and expiration in July, the XYZ July 50 call. The call is purchased in January. If the stock has been trading between $40 and $45 for the past 6 years, the odds of the option rising above $50 by July are relatively slim. As a result, the XYZ July 50 call option will not carry much value because the odds of the stock moving up to $50 are statistically small. However, suppose the stock has been trading between $40 and $80 during the past 6 months and sometimes jumps $15 in a single day. In that case, XYZ has exhibited relatively high volatility and, therefore, the stock has a better chance of rising above $50 by July. Basically, an option, or the right to buy or sell the stock at $50 a share, will have better odds of being in the money at expiration when volatility of the asset is high. As a result, the options will command a higher price if the stock has been exhibiting higher levels of volatility. Buyers will be willing to pay higher prices for the right to buy or sell the underlying asset, and sellers will want a greater premium to take on the obligation related to assignment of the option. All else being equal, indexes and exchange-traded funds often have lower premiums than stocks for the same reason. Since indexes and exchange-traded funds consist of many stocks, there is more diversification and consequently less volatility. Stated differently, indexes are less likely to see dramatic one-day moves than are individual stocks. The options market recognizes this fact, therefore, the premiums are priced accordingly. Standard characteristics of options contracts. Whether trading futures or stock options, all contracts share certain basic characteristics. For example, all call options give the owner the right to buy a specific asset at a specific price for a predetermined period of time. This is true of stocks, indexes, or exchange-traded funds. All options contracts share the following 7 characteristics. 1. Options give the right to buy or sell an instrument. 2. Option buyers or owners are not obligated to buy or sell the underlying instrument, they simply have the choice or option to do so. 3. An option seller or writer is obligated to deliver when selling a call or to purchase when selling a put the underlying asset at the predetermined price if the assigned option buyer exercises his or her right to take delivery or to sell. 4. Options are valid for a specified period of time, after which they expire and the contracts cease to exist. Options expire on the Saturday following the third Friday of the expiration month. 5. Options are bought at a debit to the buyer. The cost is deducted from the trader's trading account. 6. Sellers receive credits for selling options. The credit is an amount of money equal to the option's premium and it is added to the trading account. 7. The strike price available for an options contract reflects the price of the underlying security. For example, if XYZ is trading for $50 a share, the options might have strikes of 40, 45, 50, 55, and 60. The number of strike prices will increase as the stock moves higher or lower. An important note. Exercising an option is not the only way to bank a profit or close the position. Instead, an option position can, and often is, closed at a profit or loss prior to expiration through offsetting transactions. To offset an open long position, the trader sells an equal number of contracts in the exact same options contract. For example, an account that is long 10XYZ June 50 calls can close that position by selling 10XYZ 56. The index trading course. June 50 calls. When the trade is established, it is an opening transaction. The offsetting transaction is a closing trade. In this example, the trader